Yeah, thank you guys for the invite and the opportunity to chat for an hour. So I'll be talking about my job market paper today, which just gave a very nice intro on. And really there's kind of four sections to it, four areas of contribution, which are as follows: kind of some basic motivating empirical facts. Secondly, which is the main contribution of the paper, is some novel estimation and inference procedures for a high dimensional dynamic latent factor model, which is a lot of buzzwords that I'll define each piece super slow. And then the latter two parts are the empirical applications of that model comparing to other kind of classic factor models and more recent ones. And then the fourth and final section is just kind of forgetting all this interpretability and research questions, inference procedures. Let's just maximize out of sample risk-adjusted returns. How well can we do with a kind of modern machine learning approaches, deep learning tools within a factor model structure, to maximize out of sample Sharpe ratios. So it was kind of a little too much to talk about in 50 minutes. And I want to go super slow because the main contribution, the econometric theory that I mentioned, is a little technical. But yeah, I think Nir and I were discussing and wanted to focus on that. So I will just be kind of mostly focused on this new estimation and inference procedure. And then as time permits at the end, we can get into more of the empirical stuff. So maybe like 30 minutes or something on the theory, and then the balance of the time on the empirics. But yeah, as you guys said up front, feel free to jump in with any questions. Very happy to chat about whatever you guys want to chat about. Happy to let you guys drive what is of most interest. So with that, let's get set up. So first, I'm just going to kind of preview the results of this econometric theory. And you may not follow all of this, but don't worry, right after this, I'll go step by step, including kind of like walking you through the factor model literature. So that you understand everything when I come back and define this setup and the estimation procedure and the contributions more slowly. But so to start, consider dynamic latent factor model with linear loading. So what that means is that we are modeling returns of assets. So we use R to represent that random variable. This is a scalar random variable. We use subscript I to refer to different assets. And then we're modeling these returns over time. So this is panel data, assets, a bunch of assets we observe over many, many periods. And we model that as a factor model. So there is some beta, which we call a factor loading, that is specific to each asset. So it's subscripted by I here. And then also if it's a dynamic factor model, this factor loading is also time varying. It changes over time. And then, factor loading is a dot product with, so this is a low dimensional vector. This is like, say, k dimensions. Think about it as like 3, so a 3-dimensional vector. But we take a dot product with that and then these factors. So in a latent factor model, these factors are unobservable and we have to estimate them. And again, just like a length 3 vector, I'll talk more about that, but we just assume low dimensional here, that there's only a few factors that you need. And importantly here, these factors are not specific to assets. They are just a time varying random variable. So that's kind of a core assumption in the factor model and cross-sectional asset pricing, is we assume that returns are a function of these common time varying factors, that all returns can be modeled as they're loading on these factors that are shared across all the assets. Okay, but then in a dynamic latent factor model, this beta, because it's specific to assets and time, would be a cap n by cap t matrix for every asset and for all time periods, and you estimate all those betas. So that, as I'll mention in a second, is over parameterized. So we specify this beta to be a function of other data that we have, which is this vector z. For my mouse is way too sensitive. Sorry, maybe we won't touch the mouse. I have to turn off the mouse. This beta is a function of these asset characteristics z, and z is, as p-dimensional there at the bottom, is high dimensional in practice, as I'll mention many, many times. That's kind of a key idea here, is that we have a lot of information about every asset that's changing over time. We have, say for equities, we have their cash flow, how many employees they have, what is their profitability, what is their market cap, what is the return over the last month. And we can recreate these, as recent literature is doing, for crypto assets, as I do in the empirical applications. Okay, so vector, please.
Can I ask a question?
Please.
So in terms of can you say something about, in general, the difference between this kind of approach to the classical CAPM?
Yep.
Yeah, I guess maybe people that not really
know
these models, it can kind of connect them, how to think about it.
Yep, I'm going to do that in 2 slides, super slowly, so you kind of see the evolution of literature, and this will make more sense. But just kind of wanted to get quickly to the contribution in 2 slides. But basically, I may actually just leave that question for 2 slides if you don't mind, because I'm just, perfect, cool. Because I have it kind of nicely laid out. But this is a dynamic latent factor model. I'll leave it there. I'll work up to this as well. And as I mentioned, we observe these scalar asset excess returns. Returns are always excess in relation to the risk-free rate. So of every asset's returns, we take out the risk-free rate, like what is a 1-month treasury. And then, we observe these asset characteristics, and we have conditionally mean errors there on the observable asset characteristics. You can think about these asset characteristics as your covariates, right? Like your right-hand side random variables, and then our parameters here are going to be this gamma, beta, and the factors. We need to estimate both of those. Okay, so in this setup, under the novel asymptotics, so nobody has come up with consistent estimators for those 2 parameters I mentioned, the latent loadings and the latent factors. Under the novel asymptotics of P grows jointly to cap T and cap N. So I allow P to grow large asymptotically, jointly, so joint limit with cap T and cap N. I contribute a new estimation procedure for these 2 parameters, and I prove the consistency of these estimators. It combines double selection lasso, PCA, and soft thresholding. I'll go into details on that, but that's just a little preview. So not only do I have these consistent estimators, I also kind of extend this for a more hypothesis testing procedure, but develop a inference procedure for a classic asset pricing test. And I prove the asymptotic validity of this inference procedure and show it works in simulation. And as a further preview of that, it's addressing a question that maybe we all care about in crypto, of what is the inflation risk premium in crypto? Do you earn an average return for exposure to inflation by holding some set of crypto assets? Okay. Okay, so that's the preview. Happy to take any questions. Just want to make sure I don't miss anything. But now I'll go kind of super slowly through the factor models and circling back to Nir's question on connecting it to CAPM and these equilibrium models. Okay, so the motivation here, I'm just going to go through kind of the evolution of literature. So for all time periods and for all assets indexed by I, the literature starts out by not just assuming we observe these scalar asset SX returns, but that we observe these factors. And again, fundamentally, these are low dimensional. We believe, because of theory, that we only need 1, 2, 3, 4, 5 of these to have good, basically, predictability or explainability with our model. And that empirically has been shown to be somewhat true over the years, at least explaining in sample, maybe not so predictive. Okay, and then we specify at first, this would be your Fama Macbeth, which maybe you're familiar with or have come across, a static observable factor model, which is that these asset excess returns are a linear function of the common time-varying low-dimensional factors, where each asset has its own factor loading beta. So this is like an n by k matrix beta that we need to estimate, and we observe the returns and the factors. And then, just to give you an example, the classic factor is the market return. So just take a weighted average of all the assets by their M cap, and what is the return of that portfolio? That's the market factor. Okay, so that's how literature starts. This this is a statistical model with a moment condition on our error term, which is how I kind of approach it just from like a statistical approach. That'd be kind of like arbitrage pricing theory. You assume no arbitrage, you can get to this statistical model pretty quickly, as I do in the paper. But you can also, as Nir was mentioning, you can start out with an actual economic model, as CAPM does, and then derive out this statistical model for returns. And so, yeah, this like, or you can also start from like a law of one price. So this has like theoretical underpinnings that motivate this statistical model. But I kind of, in my work, just skip over that stuff and more focus on the statistics econometrics. And this really is the cornerstone cross-sectional empirical asset pricing model, which is why I use it to contribute to the nascent literature of crypto empirical asset pricing, studying the average returns of different crypto assets. Okay, yeah, our epsilon is our idiosyncratic error, beta is our factor loadings, also k-dimensional. We can estimate this because we have the n by t matrix of returns, we have the t by k matrix of factors, and we're just estimating this beta, which is n by k. And yeah, classically, this is like estimated with Fama-Macbeth regression procedures. Cool. But you know, in that you need to specify these factors. You have to say the market size, 1 month momentum, these are the best factors that you need. And everyone argues about what are those 3-4 factors. The literature has, you know, 100, or in crypto, even people have, you know, studied the performance of those similar factors, you know, say on the order of say 100 or 200 different kind of characteristics-based factors. So you have to take, if you want to follow this model, you have to take a stance on what are those 3-4 out of the 100, and that's kind of a, you know, arbitrary decision. And so the next evolution of the literature that, you know, kind of started happening in like the 90s, early 2000s, the main paper on the econometric theory is like the 2003 paper, is to not specify those factors, but to learn those factors. So notice I moved those factors from being observed just down here to being unobserved, these low dimensional factors. So that's a static latent factor model. So our betas are still just specific to assets, but they're static, they're not changing over time. But now just these factors are unobserved. So now all we have for observable data is the matrix of returns, cap n by cap t, matrix of returns. But we're estimating 2 parameters, beta, n by k, where again, k is low dimensional, and factors t by k, where k is low dimensional. So these are smaller matrices where we only let n and t go grow large asymptotically. So we estimate this by a PCA. We decompose this n by t matrix into these lower dimensional matrices, n by k and t by k, to estimate jointly our loadings and our factors. And we have identification issue there that I'll mention briefly, but I don't go too much into that in my paper because, as I'll mention, I kind of don't focus on that aspect of this fundamental identification issue in factor models. Okay, but
can I ask a clarification question?
Please.
So the difference between the factors that are unobserved, like my question is, in some sense, like the idea is that you can have like a big amount of factors.
Yep, like I say, 100, 200. Yep.
Yeah, and then like more like instead, maybe in my sense, like the definition is a little bit seems to be that instead of unobserved, it's more like which of this big list of factors are the ones that going to kind of be the best fit.
Yep. Yeah, you can think about it like that, as like we're selecting some subset of these factors, and there is a subset of literature that very much approaches the question like that. That is basically, let's do like best subset selection. We all know that we only need 3, 4, 5. Once you have 3, 4, 5, the rest are kind of redundant. And then, yeah, you can choose your model selection criteria exactly how you're saying, as some measure of fit, like BIC, AIC. There's adjusted ones for factor models, you know, adjusted AICs, BICs, or some other R squared or whatever. But there's also like another approach in the literature of like, we don't even think about these factors as necessarily like interpretable, like it's the, you know, market factor or the size or momentum, but it's just like kind of some function of returns that maybe has some interpretability. But we don't really care about it mapping to something that's very interpretable. We just want to maximize the performance, maximize predictability or explainability, whether it's contemporaneous or predictive. And yeah, and then it's like, yeah, just do PCA and not worry so much about the interpretability. So there'd be kind of like, you know, you can take different approaches there.
I see.
Basically, yeah.
Thanks.
Yeah. Okay, cool. So yeah, that's kind of second evolution of the literature. And then the next, and kind of where it stands today, is, well, why do we believe that this relationship between returns and these common time-varying factors for each asset, this beta I, the factor loading, is static, is not changing over time? We all know, for example, in crypto, that the market is very different during the boom times and the bust times, or more broadly, you know, business cycle. You know, we also see that in equities or other asset classes, or maybe there's other structural breaks is the term, like structural breaks in the data generating process of returns. There's different market regimes. And so maybe we want different betas for those different market regimes. So that is the third evolution of it, which is a dynamic latent factor model. So now all I've changed is that these betas are also subscripted by T, they're time varying factor loadings. But the problem with that is now we're way over parameterized. This beta matrix is N by T by K, and the factors are T by K, but we only got N by T data, the returns. So another aspect of these models is bringing in the asset characteristics. So we parameterize the betas to be a function of these asset characteristics. So now all we're estimating instead of the betas is we estimate this gamma beta. So this gamma beta is P by K if Z is P dimensional, our asset characteristics P dimensional, and our gamma beta, like the loading mapping, is P by K. So then we have low dimensional matrices, or matrices that only have one dimension that is growing asymptotically. The loading mapping is P is growing, K is fixed, and then our factors, if we stack them for all time periods, is T by K. So T grows, K is fixed again. So that solves being over-parameterized. We can now estimate our two parameters, gamma beta and our factors. The final thing I just want to mention here in this little review is that there's an identification issue. So we're trying to estimate this gamma beta and these factors, but we can always fit in between here a invertible K by K matrix H, or this rotation matrix. So in other words, we only identify without restrictions on this matrix H, the factor, these loadings and the factors themselves up to the rotation matrix. We would have to have K squared restrictions to pin this down. So I don't really worry about this so much in my paper. A lot of literature just, you know, it's good enough sometimes to know these loadings and the factors up to the rotation matrix. Yeah, I can get it more into that. But yeah, there's like 3 approaches, a by 2013 paper for pinning down this rotation matrix. Just want to mention that in passing. Okay, so yeah, that's kind of the motivation that sets up the model I'm working in. Happy to take any more questions on this. Otherwise, I'll move into my formal setup, which is kind of restating the first couple slides. Okay, so yeah, the formal setup, assume for all these time periods and all these assets, we observe realizations of the random variables asset excess returns, these scalar returns, and these asset characteristics Z for all assets and all time periods, which in practice are often high dimensional. In recent papers, folks are using 100, 200, 1,000 asset characteristics, which is certainly on the order of how many assets we have. And maybe it's 500, 1,000, a few thousand, and time periods, often months, but sometimes higher frequency, weeks or days. And this is even more true in crypto, where unfortunately we just don't have a lot of data. Like, we believe that basically the early years of crypto wasn't quite, markets weren't behaving how they are behaving in recent years. And then also the large majority of crypto assets aren't really tradable at like real size. You can buy $100 of them a week or something, but if you're like an institution, it's just you'd have to do like very much more sophisticated empirics. Otherwise, you'd be really moving the price by trading. So the historical data wouldn't be really valid. So we only have like maybe 100, 200, 300, something on that order of assets that we can look at. And we have something like 5-6 years of data. But we have in crypto a ton of information about these assets, right? We have all the on-chain data, we have all this social data, yada, yada, yada. We have all these financial characteristics. So in my empirics, just to give you a feel, I have like growing from 10 or 20 assets in 2018 up to like 200, 250 in the end of 2022. Weekly data, so like it's like 250 weeks or something like this. So the roughly order of magnitude the same. And then the asset characteristics are like 65. So smaller, but we would call that high dimensional. There's only like a factor of 3 or something. And certainly in the early years, I have more characteristics than assets. Okay. And this is our dynamic latent factor model. So yeah, it starts out as I'm specifying the factor loadings to be a linear function of the asset characteristics through this mapping gamma beta with this air term, but we can quickly just rewrite that as a single equation with our moment condition like such as you saw previously. Okay, I don't think anything new here. The only one other piece to mention is a crucial assumption that I'll just preview before we state them formally, is that I will need crucially to assume that this gamma beta matrix is row sparse. So basically in all high dimensional econometrics, we have to assume some sort of sparsity, which will give us some sort of regularization in the model to deal with high dimensionality of your covariates. And so here, what I assume, which is appears to be empirically true, is that only a subset of the P characteristics kind of matter. So that is, by saying gamma beta is row sparse, that means the vast majority of the rows in this P by K matrix, the vast majority of those P rows are exactly 0. So basically it kills those asset characteristics, and you only need some subset, say something like a fourth or a fifth or a 10th of those 60 odd characteristics to be able to fit or predict the data well. And I empirically show that as well in some characteristic important stuff that I'll talk about. And that's broadly true in the cross-sectional asset pricing literature. When folks look at characteristic importance of characteristics, they find that only a small subset matter. Okay. So sorry, yeah, I should meant that. The key assumption is that gamma beta is exactly row sparse. Okay. So that is the basic setup. And yeah, I'll talk about the estimation procedure for the loadings and the factors. And then, yeah, I just have this kind of extended question to basically show how we could use these consistent estimators to go at more of an asset pricing research question, and I guess a common asset pricing research question here, which is, what is the risk premium of an observable non-tradable factor, which we'll call G? So a scalar factor, time varying only, and it's non-tradable. So an example of that is inflation. We observe inflation over time, but how do you buy inflation? In some asset class, how do you, in equities or in fixed income or whatever, how do you go buy the inflation portfolio? Now, you know, we have like financial contracts that can do that in a more precise way. But if we want to recover like inflation in some asset class, this is the approach to do that. And then we want to, or this is a approach to do that. And then we want to recover the risk premium of that observable non-tradable factor in this asset class, which is basically what is the average return of that portfolio? And roughly, is it positive or negative? Is there some portfolio that's giving you exposure to inflation in crypto? And does that portfolio have a positive return or a negative return? Basically, are you being compensated with positive average returns for your exposure to inflation or negative? Okay, so just to restate some of that context, risk premium is the return for the exposure to a factor, all else equal. If a factor is tradable, so say it's like, sorry, I should have a very quick example of this. Yeah, it would be like the market factor, even though that's not the best example. It's very clear how to buy the market. You just put, if Apple is 5% of US equities, you put 5% of your portfolio in Apple. So that the market factor is tradable, you just take the time series average of it to recover its risk premium. But if it's a non-tradable factor, we have to form the factor mimicking portfolio, which was what I was kind of getting at, which is that we basically project the factor into the column space of the true factors and recover basically the linear combination of assets each time period that has the maximum correlation to this inflation factor. And so I'll give you a model for that in a second, but to do that, I basically follow the procedure of Giglio et al. In a recent paper. And I'm extending this in a couple ways that I'll mention, but the specification for doing what I just mentioned, I'm following this paper, and two kind of crucial assumptions, but for the sake of time, I'll start skipping some of the more details. So what we're doing here, though, is, what I was just saying is we're projecting this observable. So we observe what G is each time period, but we don't know how to recover its like tradable portfolio. What is the linear combination of assets to hold that maximally correlates with that? So to recover that, we just do we're going to do a time series OLS of just regressing G onto the factors, onto the true factors, where that V, you note, is not F. The V is just the mean zero component of F. So we just take what is the time series average of our factors. These are the factor innovations, is what we call them. And so this eta, by estimating eta through what's going to be a time series OLS, we can project the observable non-tradable factor into the quote unquote true factor space. And there's some stuff you have to assume that we're covering the true factors. So this is the specification from Giglio and how we map this observable non-tradable factor to true factors. And what our target parameter is going to be is not just how do we map that to the true factors, but its risk premium. And so how our target parameter is going to be the risk premium of the true factors, the time series average return of the true factors, gamma. But we want to map that to what is the risk premium of our observable non-tradable factor G, and that mapping is this eta. So this would be like a three-dimensional vector, right? Because F is like three-dimensional K. So that is our target parameter. Another nice thing in, I think I cut it out. Sorry. I'll mention something later on the rotation and variance. Okay, so just to summarize before I give you the estimation procedure and just show you the kind of asymptotic results, we have this dynamic latent factor model. First specification, we have this additional model that relates our observable non-tradable factors to the true factor innovations, the mean zero component of F. And there's two theoretical contributions in this setting. Both are under these novel asymptotics of allowing P to grow jointly with cap T and N. First is consistently estimating our latent loadings and our latent factors. And the second is conducting inference on that risk premium of our observable non-tradable factor, like inflation. And then also under this extension, this is the first use of a dynamic latent factor model to recover this risk premium.
So can I ask two questions?
Please.
First, there is like kind of a support, maybe we will show it later, why this new approach is going to do better in prediction the market than the previous one. And
Yep.
And second, about the second contribution. So it can be used in any domain, right? Like even that you do with crypto, we can adopt it, use it with stocks and whatever. Yeah.
100%. Like, I try to leave, because this is like econometric theory I try to leave it more general on the slides of like any asset class, but I'm very interested in crypto assets. So that's where I apply all the empirics against the advice of my advisors that, don't do new method and new asset class, just do one or the other, and crypto's fallen out of favor a little bit, it seems, in recent year or two, but whatever, I'm still interested in it. And then, on your first question, yeah, we would, like these assumptions are all well and good. Okay, cool. You can, use a bunch of characteristics. You're not restricted to just a few characteristics. Cool. You have this dynamic loading. You don't just have some static loading. But does it actually work well in practice? For sure. Very important question. So the TLDR is kind of. So it beats most models, but doesn't beat every model. IPCA, which is like a very recent method for a dynamic latent factor model, but can't use a high dimensional characteristics. You have to only use some subset. It slightly outperforms. I mean, you can argue it's like order of magnitude the same, both on economic and pricing abilities, so like some measure of fit or measure of prediction out of sample. But the way I try to argue that in the paper, that's not the end of the world, is I can still do all these interesting things. So I like asset pricing, hypothesis tests, academic questions. IPCA can't do that with a high dimensional number of characteristics. So I can ask jointly which characteristics seem to matter. IPCA, we could only do 5, 10 at a time, but then you're not asking the joint question of all the characteristics. And then I also, extend it to this other asset pricing research question of basically what is the risk premium of inflation in the crypto asset class. So yeah, that's kind of, those are the highlights of the empirics for you in 1 minute. But we can get to that to the extent that we have more time. But I just want to mention the kind of the results, the estimation procedure and the theoretical results in maybe the next 5, 10 minutes, and then we can move to the empirics. Okay, so yeah, we'll skip this literature. Just the thing I mentioned up front when we were chatting before the talk is this kind of relates very closely to the biased machine learning literature, just in case I know there's only a half dozen folks here or whatever, and maybe some people watching the recording, but just in case anyone wants to go down this path, I put a high bet that DML will be used within factor models to get more at some causal inference question, not just what are the drivers of returns, or what are causing the returns to be what they are. But that requires some complicated econometric theory, but someone can certainly figure that out. Okay, so the estimation procedure. We laid out our entire setup. How do we estimate this model? How do we estimate this dynamic latent factor model with high dimensional characteristics? So this is our specification. This is our moment condition. So the first order thing would just be do mean squared error, right? That's what we always do when we do estimation. Take the difference on average, between the square difference on average across the whole panel between your outcome and your model. But that would be a non-convex optimization procedure because we need to estimate both gamma beta and F. And that is what IPCA does, which would be like kind of a state of the art for estimating this model. And they have like an iterated least squares approach for estimating that. But they, crucially, they have to assume that P is fixed, that P does not grow with cap T and cap N. So they can't do high dimensional characteristics. And just mechanically, you cannot include more characteristics than you have assets or time periods in the model. So to get around that, we have to do something different. And the first step is let's rewrite the model so we can see that we're actually in a pretty simple setting. This looks complicated, but is simple, just a lot of notation. So this Z is a P-dimensional vector. And then if we, try not to touch anything, if we just think about this gamma, beta, and F together, that's what we need to estimate, right? And then we need to separately estimate each one. But together, it's just a P-dimensional vector. So we have a P-dimensional vector times a P-dimensional parameter. And we can rewrite that as like one component of each P-dimensional vector. So ZITJ, just a scalar random variable. And then conceptualize this C to T plus 1J, as just a scalar parameter. And then, so think about this as like your treatment variable and your treatment parameter. And then these are your controls and the parameter on the controls, to use like some other econometric language. And then we have our error term. So that, if we consider each time period by itself, is just a high dimensional cross-sectional setting. For each time period, we have N assets and we have P covariates, and P and N are on roughly similar order. So just high dimensional cross-sectional setting, but we're doing this over many time periods. So it's just high dimensional panel data with a time varying coefficient. This coefficient is different in each time period. So if we consider each time period on its own, as I was just saying, and we want to estimate this CT plus 1J, just a scalar number. This is like a K, 1 by K vector and a K by 1 vector, so it becomes a scalar parameter. So to estimate this scalar parameter for each time period, the first order thing you would do would just be run lasso to account that P is on the order of N. So just basically do OLS, but you have this penalty parameter to select some subset of the Z's from all of them. But if we did that, that would introduce bias, because lasso basically trades off bias and variance by introducing a regularization, and that bias would pass through to doing inference procedures. If we cared about doing like asset pricing research questions, hypothesis tests, any hypothesis test we built on top of that would have some bias. Our distributions would not be centered at the true parameter. So the recent, from like 5-10 years ago, tool to basically run lasso, but to debias lasso, is double selection lasso. I won't get into the details. I have an appendix slide on the procedure, but basically you run a couple lasso procedures and you can basically debias lasso by doing this iterated procedure. But you roughly think about it as lasso in each time period to estimate CT plus J. Okay, so that just is to estimate the CT plus J for each time period and for each J. So we need to estimate that for all the J's, for all P of them. So we have to run P cross-sectional double selection lassos for each time period, but then we have to do that for every time period. So one downside here is a lot of estimation procedures, because T and P are high dimensional. Like in my sample, like 260. So 200 times 60 regressions. But the good thing is each one of them is very small and you can run them all in parallel. It's on the order of like 2-3 minutes. So not too bad. Okay, but that is just estimating basically this. If we stack this together, this C matrix that is T by P. But what we really want is our target parameters, our gamma beta and our Fs. So to estimate gamma beta and to estimate cap F, basically the factors for every single time period, we can just decompose C hat into those two estimators. And so this is really just using high dimensional PCA when you're decomposing a matrix that's high dimensional, T by P, into low dimensional matrices, T by K and P by K. So K is fixed, right? So I'm just inheriting the high dimensional PCA here, but not traditionally in this literature on the return matrix, but on this matrix C. Okay, and then I've assumed, as I mentioned, row sparsity in our gamma beta, that most of the characteristics drop out. So there's this last little step of just soft thresholding gamma beta hat, which basically means just take like the L1 norm of all the rows and some below some hyperparameter, set them all to 0, and we just leave some, say 20% of them non-zero, and we cross-validate that hyperparameter in practice. Okay, so that's kind of like one contribution, is figuring out this estimation procedure for this model. Happy to answer any questions. It seems kind of involved, but it also mirrors like how people estimate these models in practice. The following Macbeth regression procedure I mentioned runs a bunch of time series regressions and a bunch of cross-sectional regressions to estimate factor loadings. So it kind of mirrors common practice in the literature, even though it is a little bit more involved. But high dimensionality doesn't come for free. Okay, yeah, I'm rapidly running out of time. I'm supposed to be done with this 10 minutes ago. So let me just kind of quickly go through this estimation procedure and then just highlight the results so we can talk about the empirics for the balance. So yeah, we have this model for the risk premium of a non-tradable observable factor. Basically, what we're just going to do is do 2 more regressions, a time series regression and a cross-sectional regression, just following the Giglio procedure. And yeah, this was where the identification thing is, but I'm just going to skip that. It's not really important. But basically, we estimate our factors and our loadings as we did, just as I mentioned. We just use d-mean returns, the same exact procedure. And then we need to run a cross-sectional regression and a time series regression. So 2 more regressions we need to run to recover this like risk premium of the true factors, and then also the mapping from the true factors to our observable mapping. So to our observable factors, and then we just take the dot product between gamma hat and eta hat to get our target parameter, gamma G hat. Okay, so Yeah, I just, in maybe 2 minutes, I'll just kind of show you the consistency results. We'll kind of skip the proofs, just mention the simulation, and then we can chat about empirics. So we need that sparsity assumption, a more technical assumption, and a bunch of other standard assumptions. I just list those 2 assumptions because those are like the novel assumptions and the kind of key assumptions that I have on top of the existing literature. But then we get consistency of our latent factors. This is like a kind of a classic high dimensional rate. So, and everything, and this is like kind of one downside or just reality of the situation, is that I need n to grow faster than t and p. But here, this is a log term. So log kills high dimensional t and p very quickly. So this is a very fast rate. S is the how many of the p characteristics are relevant. So again, like a small number, like 10%, 6, you know, in my 65 characteristics, but yeah, it's about the ratios. Okay, so we get consistency there. I use a bunch of high dimensional kind of recent toolkits to do that, but we'll skip over the theory there. And then we get the same rates on the soft thresholded latent loadings, but we get consistency there as well. And again, we use some recent high dimensional tools. And then we also get our normality for the risk premium of our observable non-tradable factor. Like, what is the risk premium of inflation? We get some nice normality result here, so we can conduct inference using standard methods at a root t rate as well. Okay, so let me just mention the simulations, and then we can talk about empirics, or I think we're going till 11 with some extra time for questions. So in this Monte Carlo simulation, we want to study the finite sample. So cool, you can prove the math, things work when p, cat t, and n are infinitely large, but how does it actually work in finite samples? So I'm trying to get something close to my actual setting, my empirical setting, but I'll show you some things that aren't exactly perfect. But yeah, we want to basically show, do those 2 estimators appear to be consistent? And then do we have nice coverage properties of that inference procedure? If we run the simulation, we know the true DDP, we should be getting coverage of our confidence intervals at 90% or 95%, whatever we're doing. And then we also want to compare this to like relevant benchmarks. So when you do high dimensionality, things generally break. And so basically we want to see that our procedure doesn't break as much as existing procedures. So the DGP, we use 200 simulations, we use 100 time periods, it'd be like 2 years of data or something. And we use 500 assets. So this is a little bit more like favorable to me than the real empirical setting, because these are actually more on the similar order, like 250, 250. But I need n to be larger than t for like the asymptotics to kick in, is the expression for like the errors to get crushed. Low dimensional factors, P, I do a low dimensional simulation and a high dimensional. So 10 characteristics and 50 characteristics. Each time only 10% of the characteristics are actually relevant. And I basically set up the simulation to have IPCA, which would be the state of the art for a dynamic latent factor model. I've set it up for IPCA to basically do well. The GGP follows their simulation. The parameters are numbers coming from IPCA fit to my real empirical data. So in other words, IPCA should be doing well. And yeah, we'll just skip over some of the details on the GGP, but whatever, we generate returns according to the model and generate parameters according to the model. And so we can go to the numbers, or maybe we'll just do the takeaways and we can show you the numbers if you want. So we have low dimensional and high dimensional. And this is like not so high dimensional, but it already starts breaking everything. So it's high dimensional enough. And like, in other words, if I went even more high dimensional, like my results would start even to look more favorable. So anyways, in a low dimensional setting, I have a factor of 3 superior estimation error for like our main parameter of interest, these latent loadings, as compared to IPCA. So my MSC's a magnitude of 3 smaller. I unfortunately am an order of magnitude, so 10 times inferior on the latent factors. But again, this is like a low dimensional setting as compared to IPCA. And then for that Giglio procedure, for the inference procedure, that I'm kind of following their approach with a couple of new things. We both kind of don't do perfect. I undercover by like 6-9%. Giglio overcovers by a little bit less, 2-4%. But then things move in my favor when we go high dimensional. I get even better on the estimation error of the latent loadings. Unfortunately, it's still inferior, but by not 10 times, but 4 times on the latent factors as compared to IPCA. I attribute that to like setting things up for IPCA, following how they generate factors, setting it up for IPCA to do well. And also I have results for like P is 100 and IPCA really breaks. But when I do super high dimensionality, it also breaks my inference procedure. So this was like kind of the best balance between that. So when I go high dimensional, my inference procedure doesn't degrade that much. Basically, I maintain somewhat okay coverage, like 85 when 84 when it should be 90, or like 86 when it should be 95, basically like that. While Giglio degrades much more. It starts way over covering. Confidence intervals are like over 100%. Okay, so that is the Monte Carlo evidence. I think we're coming up on time. I'll just mention kind of what I can talk about in the empirics. I'll pause for more questions, and then, yeah, to the extent we're interested, we can talk about whatever empirics, although I know we kind of already previewed some of the takeaways already. But I broadly studied, the dynamics of crypto asset returns. In particular, I look at the expected returns, basically how well do models predict, through the lens of factor models. So I kind of stay true to factor model structure throughout. First, just kind of like what characteristic-based factors, univariate factors, are the drivers of returns. I kind of circle back to that question in more sophisticated models, like I mentioned in my model. Also ask this more kind of asset pricing question of inflation risk premium in the crypto asset class using the standard procedure, and then using my updated procedure. Takeaways, it's positive. And then that very last thing on relaxing kind of the interpretability, staying true to a factor model, but you're not gonna be able to do any inference or anything. Let's use some modern machine learning to maximize our out-of-sample predictability. How well can we do? So happy to talk about any of that stuff, but yeah, I'll pause here because I think this brings us to about 50 minutes.
I think like if you want maybe to have like 5 additional minutes to show the main results, go for it.
Yeah, that works. So I think we want to maybe see like the double selection lasso, like how well does this model I just talked through do? So let me do that. I can circle back to talk more about the panel because there is some like things here that I think are novel, but like one kind of main thing. But just roughly the data we're working with is in a weekly panel of crypto asset returns, minus when I do that deep learning stuff, I go hourly to get like a ton more data. But yeah, in everything else, we're working weekly panel from 5 years of data, and we have 63 characteristics. And we start out with like 10-ish or something assets in the first week of 2018, and we grow to like 200 or something. And then, yeah, we have 250 odd weeks. Okay. So there's this point here we can circle back to if you want to hear about this, because I think this is important. And also this inclusion criteria is important. I argue that I have like a much more realistic set panel than what is currently used in the literature, because folks are including a bunch of assets that are basically noise, like are not tradable. You would move the price a huge amount if you just traded any material amount, just like 5K, 10K or something like this, and certainly any institutional size. Okay, a bunch of empirical facts we can circle back to. But yeah, let's focus on the main stuff. So I may actually even go to the paper because these tables are large. But yeah, with this new model, I want to compare it to, kind of other factor models and just out-of-sample predictability. And then I want to do that characteristics importance that I mentioned, and then ask that kind of more asset pricing question about the inflation, the risk premium of inflation. Okay, so in regards to the first question, this is the out-of-sample performance of a bunch of benchmark models. So there are like 4 sets of models here, all with a varying number of factors, 1, 2, 3, or 1, 2, 3, 4, 5. This is a multivariate model where I basically do this procedure to do that kind of best subset selection. We have these 63 characteristics. We can form 63 factors out of those 63 characteristics. And if we do some subset selection where I literally try every subset of 1, 2, or 3 of them, which one performs best kind of in a cross-validation procedure. And then let's take this out of sample it's the last 6 months of 2022 for everything. So the last 2 quarters of 2022, how well does it do in those 6 months? And then I do this kind of Fama-Macbeth type model from an existing paper studying crypto, including their 3 factors. Then I do PCA, 1, 2, 3, 4, 5, and I do IPCA, 1, 2, 3, 4, 5 factors, where I just choose again in that cross-validation procedure. And I think I got kind of lucky with this, some subset of the characteristics, because we have to pin that down. We don't have a procedure for that. So we just kind of like play around with a bunch. There's way too many to choose. You can't, 63 choose 10 is a very large number. But anyhow, so these are the benchmark models. What we're looking at here, so predictive R squared is like the pricing ability, like how well does it guess each return, basically. And everything else is basically economic measures. So, okay, great. If you can price well, does that actually translate to getting a spread in returns? We often look at spreads and returns to basically say, like, the assets that you say have the highest returns every single week for these 6 months, do they on average have higher returns than the assets you say have the lowest returns? So that's the difference between the top and bottom quintile, 5 and 1. So all of these results on the right-hand side are 5 minus 1. So we want to see positive numbers for the time series average of that return. We want to see large Sharpe ratios, so the risk-adjusted version of the time series return, and then some other statistics we care about for that return of that portfolio over those 6 months. But the upshot is IPCA has small positive pricing ability. Any positive predictive R squared is like a great thing. So like in IPCA's first empirical paper, these numbers are like 30, 50, 60 in US equities. So that's like a fraction of 1% for a predictive R squared. But anything like 20, 30, 50, 1% is a very good predictive R squared. And then we want to see, Sharpe ratios above 1, above 2, 3, and 4, like massive Sharpe ratios. So those are kind of the benchmark models. And so this is just, out of sample predictability for both just like pricing ability as well as is that economically meaningful. And then in comparison to double selection lasso, it has positive R squareds, but not for every single factor, for only a single factor. So somewhere between IPCA and all the other models that had negative predictive R squareds. When I do market cap weighted portfolio, the average of these numbers is something like 1.5. So similar to these more simple low dimensional models, but is getting crushed by IPCA. But if I do equal weighted portfolios, this is a common thing between MCAP weighted and equal weighted, this Sharpe ratio jumps up a little bit and gets closer to IPCA, but still not reaching like its max of 4. The average of these numbers is something like 2.5 or something, where IPCA is a bit better than that. Maybe the average of these numbers is like 3 or 3.3 or something. So order of magnitude similar, but I would argue is getting beat by IPCA in both pricing ability as well as economic meaning of those forecasts. But then, as I mentioned, by using double selection lasso, this factor model, we can do kind of asset pricing tests that we couldn't do with IPCA, where, and I'll show you these 2 things to close out. The first is this characteristic significance. So we estimate that gamma beta matrix, that P by K matrix, in our out of sample period. And we want to ask basically what characteristics across all those weeks seem to be driving returns. So what is the magnitude of that coefficient for each characteristic? And so for each row, there's 3 numbers in each row, say K, if it's 3 factors. We take the dot product of that vector with itself. Basically, it's L2 norm to get the magnitude of that coefficient associated with each characteristic. And an interesting result here that is kind of a bit different than when we studied these characteristics kind of individually, not jointly, is that the double selection lasso factor model seems to be using exchange flows to predict returns. It's using, this is like a larger than an order of magnitude than the rest of the characteristics. And it's using inflows and outflows for these variables I have of inflows and outflows of the top like 4 or 5 US exchanges. That seems to be driving returns. This is corroborated by more like industry stuff. Like people in industry know that and they use that to predict returns. but is a bit different than my univariate factor results, which were much more financial, basically just functions of previous returns, momentums and other higher moments of returns. So interesting. And then kind of the second thing about it is I should really be using approximate sparsity, not exact sparsity. In my theory, I assume that only basically it's like 5 of the 50 or have a number, everything else is exactly 0. But this looks much more like approximate sparsity, where basically your coefficient decays, right? But decays very quickly. The theory would go through with approximate sparsity. It's just like more complicated math. And this is basically what, if you look up characteristics importance of anyone doing a dynamic latent factor model, this is like the figure you always see. Is it like decays very quickly? Only a small subset are relevant. Everything else you don't really need, which is basically the same thing we see with factors, right? We only need 5 factors out of the 200. Once you use those 5, everything else is adding very, very marginal signal. Okay. The last thing is just on the inflation risk premium, which is a small positive number, and 1.4 bips a week, which corresponds to a small number but meaningful number, a 7% excess annual return. So basically what that means is by doing this inference procedure I mentioned, it recovers the linear combination of crypto assets in my panel each week that correlates maximally with inflation, and then calculates what is the average return of that portfolio over this 5-year period. And that corresponded to, on average per year, a 7% return beyond the risk-free rate. And that is statistically significant as well. And I found a similar number, positive number, just using the following Beth regression procedure. But you could argue that we found that this model had better pricing ability than that kind of simple observable factor model, which is what I would use for this classic procedure to answer this question. So that's a good thing. When, just one final sentence here, when Cliff Asness tweets out, the return of Bitcoin over some 6-hour period, when a bad inflation print comes, Bitcoin's price drops. That's a price impact regression. This would be the much more sophisticated way of asking, basically, do you have a return in the crypto asset class for your exposure to the risk of inflation? And yes, you do. It's a positive number. You just have to collect the right portfolio. All right, I'll pause there.